Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, given that so many people are worried about the unknown consequences of coronavirus and the fact that it's certainly escalated in the last couple of weeks, I thought it was timely for me to share my thoughts and advice. And just like in any crisis, it's important to not let fear or emotion drive your response. And as the saying goes, a steady hand on the tiller is the best approach when navigating any storm. Now, I acknowledge that the coronavirus has caused significant emotional and health distress to many people around the world. And of course, I fully empathise and understand that with the situation, and I certainly don't seek to downplay its impact, particularly personal impact. My entire commentary in this podcast today is all about the financial concerns and considerations, not the health concerns. So please, if I say it's not a big deal, I'm not talking about the health impact for some people that have devastatingly lost their lives. What I'm really talking about is its impact to your personal financial position over the long run. Okay, so the first bit of advice I have for you is that we've heard it all before. I was glued to the television during 2008 and 2009 in the midst of the GFC because I held a lot of shares at that particular point in time, and it was really the first market correction that I experienced as an adult, or certainly an adult as a financial planner at the same time. And I would hear things like financial markets are closed, all banks are going bust. I vividly remember someone saying the way we conduct global business has changed forever. It will never be the same again. Property markets will take decades to recover. All these alarmist predictions and commentary and so forth, and it certainly created a lot of panic. And I could certainly understand why people were saying that during the GFC, but at the end of the day, it was proven to be all wrong. You know, everything got back to normal eventually. Sure, a few banks, Bear Stearns and Lehman Brothers, went bust, but in the main, the banking sector survived. I mean, it needed help, government bailouts and so forth, but it did survive. You know, the human race is incredibly resilient and innovative. We've faced many, many challenges and prevailed, and this coronavirus situation will be no difference. Of course, there'll be loss of life, which is, as I said, incredibly devastating, but the financial impact to the vast majority of people in the long run, just like with the GFC, won't be that significant. It's significant in the short term, sure, but in the long term, it's unlikely to create a problem. You know, and as the coronavirus risk passes, I'm sure Australians will get back to spending and try and get the economy back to normal levels as quick as possible. And I anticipate that people will probably support the sectors and industries that have been impacted the most, like hospitality and tourism. And we saw that sort of community mindedness throughout the bushfire events earlier this year and late last year. And I think that same community mindedness will serve us really well once this coronavirus risk passes. And whether that takes 1 month or a couple of months, who knows? But it is a very short-term impact. And our lives are full of predictions, and usually the most extreme ones get the most amount of airtime. So just don't get sucked into it. And the best approach is really to really restrict your consumption of mainstream media, in my opinion. And worrying has never made any problem better. The next bit of advice is, and this is just not specific to the coronavirus situation, but this is really a good bit of advice to implement at any time, and that is short-term thinking creates anxiety. It always has. You know, worried about what the property market or share market will do is a cause for concern when markets are high and a cause for concerns when markets are very volatile. But short-term thinking essentially promotes you to either be greedy or fearful. too greedy or too fearful, and neither are good emotions or handy emotions or useful emotions when making financial decisions. Instead, a far superior, and I think you'll find a more comfortable approach, is to play the long game. And consider what actions you can take today that will better your financial position in 5, 10 or 15 years' time. Play that long game. Don't worry about what's going to happen over the next couple of months. It really just doesn't matter. What really matters is that you're making really sound, fundamentally correct financial decisions that are really focused on generating better long-term outcomes. And that'll help you avoid most of the mistakes that a lot of people make that can be very, very costly. And realize that sometimes doing nothing is actually the most intelligent thing to do. So when I talk about what actions do you need to take as a result of the coronavirus, it's very possible that the action that you need to take is do absolutely nothing. As I said, a steady hand on the tiller, just keep in the right direction, know where you're heading, and don't change course just because we're going through a storm. Navigate the storm and stay on track. The impact of coronavirus on the economy and share markets is temporary, not permanent. And this is something that it's very important for us to remember. Whether it takes 6 months, a year, or 2 years to recover, only time will tell. But history tells us that the impact of these sorts of events on long-term investment returns, the impact is small. The impact of your decisions and actions will generate most of the returns or losses depending on your situation. So your actions and decisions are far more important than the actual event of coronavirus, and we've seen that in the 6 months after the market bottomed out during the GFC. The US market rose 40%. I think the US and Aussie market rose about 40% over a 6-month period. So the market will get oversold typically, and then people will realise hang on, it's been oversold. It's not as bad as we first thought, and the market will come back. Now, that I'm not suggesting that you need to take that information and be greedy and dump a whole lot of money in the market tomorrow. We'll get to that. That's not what I'm saying. But my point is that in the low point of the cycle, and I'm not suggesting we're there yet either, it seems very bad, and it seems like there's just no way out. But really, in the long run, returns will be fine. And if you're wondering what's happening in the share market, probably the most sobering indication is to walk down the local an aisle of your local supermarket. And I think that's a really good example of what's going on in share markets. It's just hysteria, mass concern, and mainly complete uncertainty. And the markets do not like uncertainty and will typically then price in worst case scenario. As I record this podcast, the Aussie market since 21 February is down about 27%, and international and US markets are down between 19 and 20% over that period of time. So it's a significant correction, but really that doesn't tell the story because it's really about the volatility. It's about the fact that the Aussie market is up 10% one day and drops 10% almost the next day. It's that level of volatility that causes newspaper headlines and makes people really worried about what markets are doing. If we have a look at the volatility index in Australia, which has ranged between 10 and 20% over the past decade, this week it peaked to 55%, which is similar levels to what we experienced during the GFC. So volatility is, 3 to 4 times what it normally is, and that's the thing that causes people to panic and worry about it. Volatility in the long run won't have any impact on your returns. Volatility in the short run makes people feel uncomfortable, which is why I'm saying play the long game. And if you're worried about your super, the best advice is don't. In fact, don't look at the balance. Unless you're planning on retiring in the next couple of months, the balance of your super is completely irrelevant. If you're a superannuation investor, then by definition, you're a long-term investor. And really, if you weren't looking at your balance regularly when markets were booming, why would you start now? So the best thing is just to close your eyes and know that we'll ride through the storm, and don't worry about how volatile your super balance is at the moment. Markets always rise, markets always fall. We'll get through this. Of course, if your super has suffered more than the market or is doing particularly poorly, then it's good to go back to the fundamentals. And really, as a superannuation investor, you cannot control markets. There's only 3 things that you can control that you should absolutely spend time on optimizing. The first one is the type of fund you use, whether it's industry, retail, self-managed super fund, or a wrap platform. The second one is the investment option or the methodology that you employ, that you use to invest those monies. So in an industry fund, whether you've got balanced or high growth or cash, for example, whether you, if you're on a wrap platform or a self-managed super fund, whether you buy direct shares or use active fund management or employ a rules-based approach. So those sorts of things. And third, the fees that you pay. They're the 3 things that any superannuation investor can control 100% of the time. What you can't control is markets. But if you get those 3 things right over long term, you'll generate good returns. So looking at balance regularly only creates anxiety, and worrying about a balance, no matter how hard you worry about it, it won't increase, it won't make it go up. You won't have any impact on it. Another lesson we can take away from this event is the importance of having cash flow buffers. I typically like my clients to have cash savings equal to at least 6 to 12 months worth of living expenses, but depending on their financial position, sometimes even more than that. You know, life has a habit of throwing curveballs at us. Therefore, it's important that we ensure that we've got adequate financial buffers in place to ride out any temporary changes in income and expenses. And also, it's important to have personal risk protection insurances like life, TPD, and income protection in place as well. You know, hopefully the coronavirus won't really impact or have a material impact on most people's cash flow and expenses. But really, we can take this as a learning experience. That is, that unpredictable events can occur. And if you don't have the right financial strategies and mitigants in place, then they can cause pretty severe financial consequences. So cash flow buffer, kind of, in a way, plan for the worst, hope for the best is kind of the best approach. If your superannuation investments, another thing, if you're a share market investor, that could either be through superannuation or outside of superannuation, and your portfolio has done worse than the market. So as I said, the market in Australia has fallen 27%, international 19 to 20%. As I record this podcast, because you know these things can change very quickly in a highly volatile market. I was looking at a client's portfolio, a brand new client that had been using a really reputable international stockbroker over the last 5 to 10 years. And I was looking at some of his holdings and that have fallen by around about, or more than, 50% in value. And, you know, that's a problem. That's a problem with direct share investing, is you've got too much concentration risk, which is a drag on the overall portfolio's performance. By the way, looking at his overall portfolio's performance over the last 5 years has been pretty ordinary anyway. So not only has it been ordinary performance over the more recent time, even when the market hits some volatility, he's affected to an even greater extent. So it's a good kind of wake-up call, if you like, to have a look at how your portfolio has weathered this storm. How has it performed? Has it only fallen by the market amount, or even, hopefully, even less, depending on your asset allocation? If it's done worse than what the overall market has done, typically that's an indication that the methodology that you're employing, the investment methodology you're employing is flawed. And whilst you might not want to fix that now, while the market is, you know, at its kind of lowish point, or may possibly even low point, it's something that you might want to add to your to-do list to address once the coronavirus panic and volatility disperses a little bit. In terms of the property market, I want to provide some commentary in respect to that. Some of my clients are either considering selling or divesting of some property this year, and or some clients are actually in the process of looking for investment grade investment property. So what do you do in that space? I think if you're selling property, it's going to be difficult. Well, at this stage, there's not a lot of evidence. It's sort of patchy evidence the coronavirus's impact on the property market. I've had feedback that particularly in the higher price sector, multi-million-dollar properties are suffering a notable fall in demand and buyer demand interest and so forth. But lower-end properties that are closer to median value prices seem to be so far weathering the storm a little bit better, so no material reduction in buyer demand. That said, I think in times of high uncertainty, typically both buyers and vendors withdraw from the market and transaction volumes fall. And we saw that during the GFC. We've seen that in lots of time. Where there's uncertainty, people's typical reaction is just to delay making any decisions or transactions. And so I think it'll have a negative impact on the property market. From a transaction volume perspective, whether we'll start seeing people selling property for less than its intrinsic value, I'm not really sure. I think it'll be more a case of discretionary vendors just pulling their properties off the market and not doing anything. So if you're looking at selling a property, obviously it depends on location and price point to some degree. But my feeling is if you can list the property without giving rise to too much cost, so advertising or tenant vacancy and so forth, then there's probably no harm in trying it, particularly given you're probably going to compete with fewer properties. But I wouldn't be adjusting my price expectations too much in that I think given really low interest rates and even lower interest rates likely to be in the future, I think in the longer term, in the next 2 or 3 years, property will still do relatively well, but it might take 6 months or so to get over this coronavirus impact. So if that's the case and you're not getting enough interest or enough interest at the price that you're comfortable with, then you might be best served by pulling the property off the market, putting a tenant in it and trying in 6 to 12 months' time. What about if you're looking at buying a property? Well, of course, if volumes fall, then there's going to be fewer properties for sale and then less to choose from. So it might be difficult to find the right asset. However, I definitely don't think people should stop looking. Sometimes other people's fear works in your favour. Now, let me tell you a story that in 2008, I was contemplating purchasing a house in a Melbourne blue chip suburb of Prahran in a location called, it's in Bowen Street in Prahran. The vendors were asking for 1.6, which was above my budget at the time. And really, I remember the morning of the auction, I was sort of contemplating not going. I remember it because it was on the 1st of October 2008. And 2 weeks prior to that, Lehman Brothers had collapsed. So really the market was in turmoil. There was no good news in the media, kind of like it is today. Everyone thought the world was going to hell in a handbasket. And I was thinking to myself, why do I even bother going? I don't even think I'm in the market for this property in terms of price point. But I thought, stuff it, I'll go along and let's see what happens. Anyway, I ended up buying the property. I was the only bidder and ended up buying the property for $1.2 million. That property is worth well over $3 million today. So sometimes the best time to buy a property is when everyone else is frightened to do so. And if I was in the market for a property at the moment, and I have been looking at a couple of properties, it's kind of a good time to stay in the market. And you don't necessarily, I wouldn't be out there definitely looking for a bargain, but sometimes if you're out there, bargains can appear. What about the share market? Should you invest more in the share market, and if so, when? Well, if you've got some spare cash which you had previously earmarked for investment in the share market, then now might be the right time to do that. However, I would caution you against trying to find some cash, including borrowing it, or completely changing your investment strategy just to take advantage of the lower stock market levels. I would regard that as very much short-term thinking, almost speculative, and it's not an advisable approach. However, if you're sitting on some cash and you always were planning on investing that cash, then starting that investment process today certainly wouldn't be a bad idea, in my opinion. The best way to do that is to invest it in small regular tranches. Realise that there's probably going to be heightened volatility over the next month or so don't feel like you need to rush in and invest it all tomorrow. But just invest it in relatively small tranches over a period of time. If the market drops further, invest more, and just wait for that volatility. You must approach to these investment decisions, however, with a long-term lens. So my advice is to not try and pick stocks or sectors that you think are the most impacted by coronavirus. What you really want to do is take a really diversified approach. So because we really don't know what the impact will be to the economy in the short and long term, and also bankruptcies and these sorts of things in certain sectors will be high. And so what we want to do is really diversify sectors and our exposure to different parts of the economy. And I would be skewing my investments to markets that have the lowest sort of valuations at the moment, so the most amount of upside. So really stick to low-cost index funds, use various rules-based methodologies. So typically market cap indexing might not be the best approach. You want to use some sort of value-based approach that skews your investments towards companies with lower debt levels, higher cash flow, stronger profitability, these sorts of metrics. And do that in a really diversified manner. In Australia, that mainly means kind of the mid-cap market, focusing on that rather than getting exposure to say the financial services sector. The banks have been absolutely smashed, but that's because mostly people are concerned about a prolonged recession and its impact on doubtful debts within the banks. Now, arguably, they've been oversold, but I wouldn't be taking massive bets in that regard. Go diversified and be very careful and prudent, and obviously get some advice when making such investments. There's word that the banks will soon require loan applicants, to disclose how much toilet paper they have in the asset section of their loan application. The idea is that banks feel that a reasonable level of toilet paper stock indicates financial prudence and good planning, whereas too much toilet roll stock suggests that the applicant might be completely irrational. Now, of course, I'm kidding, right? My point is, let's maintain our sense of humour. You know, some of the behaviour out there, human behaviour, can be completely irrational at times, and we need to put it all in context. You know, I think we can get very fearful, and if we listen to too much negative commentary, we might put ourselves in a situation where we end up making financial decisions that we might regret in the future. So markets will rise, markets will fall. It's not the end of the world. This won't have a long-term impact on your financial position if you make and continue to make prudently, fundamentally sound investment decisions. Stay safe, stay calm, and until next week, bye for now.